Moon Platoon, a couple of you have been asking me questions such as, hey, what's up with those $200 GME calls in 416? Hey, calls breakdown, and what kind of investment books do I recommend? Oh, I have an answer for that one real quick. It's down in the description below. You can find a bunch of goodies down in the description below, including 2 free stocks from Webull. This is the technical trading app that I am using, the one that's showing you live price action and data, and it's entirely free. I think that's a win-win-win if you guys haven't gotten your 2 free stocks yet, or $250 of free Bitcoin from BlockFi, also entirely free. You just have to invest up to a certain number into crypto, get an 8.6% interest, but that's all for the later on in this video. For now, I want to say watch to the end because we have a big update on exactly what is going on with these in the money calls, particularly the $12 strike in the money calls that Mr. Roaring Kitty, that's right, Mr. Roaring Kitty has been sitting on and expires tomorrow. He has been going off a tweeting rampage, right? Talking about how it's time for warp drive, right? How he hasn't saved anything for the swim back. He is going to turn it up to 11. He has started to tweet almost 17 times in one day. And most importantly, over the weekend, let me see if I can go all the way back there. He put out a poll of how much should he exercise. Let me see, 14th, the 13th, almost there. Usually, so these are a bunch of memes. That's my favorite one right there. But there's a poll here that asks, right here on the 11th, exercise none, exercise some, or exercise all. And this is asking for some financial advice from you guys, asking whether or not he should exercise all of his options. What are call options? What are options at all, and what does this mean? Is this a major catalyst for the squeeze? Let's explain all of that with some data from the Stonko Tracker. Thank you, Stonko Tracker. And then we're going to go and look through the DD right here. GME calls for 416. Any nudge and hedgies are effed. Stay until the end of the video, give it a like so that more people can jump in on this stonk craze with you. More Moon Platoon members can find this video, and we're on our way to 100,000 subscribers. Would love to see you come with us. Without further ado, let's explain exactly what are these calls and how many of them are expiring in the money. What exactly is the call option? Well, let's give a quick look on Mr. Whiteboard, who is very dirty. You know what, actually? Forget Mr. Whiteboard. We'll use our new pen tool right here. Okay, so right here I can draw whatever I want. Let's draw a line for the amount of price action that we could see here. So we could see over time, right? This is going to be like Monday. Well, this is going to be like Tuesday. It goes all the way to Friday here. Let's say that you wanted to buy a contract that it has a strike price of $200. Don't worry if I've lost you. I'm going to come back to you in a second, and it expires on Friday. That means that you're drawing a dotted line all the way down to Friday and saying at some point, if the stock is worth $200, I can exercise. What you do is you have to pay a, hold on, this arrow got a little too low. You have to pay the $200 for each share along with a premium, probably around like 50 bucks, probably $20 to $50. Let's say conservatively it's going to be 220 bucks per share. Each contract is going to be 100 shares. So at the time of buying this contract, you don't have to have the money, but if you wanted to actually buy all 100 shares at 220, right? The premium is the $20 that goes to the person that you are betting against. You're going to have $22,000. Yikes. So that's why the call options are usually for people with a good amount of money. But the reason why I drew a dotted line here is because the price action, like for Monday and Tuesday, is going to go like this. At any point, if it peaks over 200 underneath this dotted line, that is going to be in the money, right? We have the ability to exercise this, right? If you exercise it right at 200, you're likely going to lose some money because you have to pay more than $200 per share. But it is exercisable, and you do want to be able to, at the very least, exercise above 200 because you would have had to spend that $20 anyway. That's right. That's what a premium is all about. That is the rationale behind $20 times 100 is $2,000 you're gonna have to pay. This $2,000 out of 22,000 is the cost of making this bet. All right, let's dump all that and now consider what the hedge fund has to do when they make this bet. Or the institution, doesn't have to be a hedge fund. Any financial institution that has the ability to write a contract is thinking about their profits. We had red before, let's do yellow. So their profits here look like this. This is break even right here at 0. And at 0, you're looking at when are they going to make $0 essentially. Well, at the beginning, they'll make $20. And that's $20 per share. So we're looking at the amount of money they'll make per share. At the beginning, they'll make $20 until the price of GME goes to the strike price, right? So at $200 right here, then they're going to suddenly make, this actually goes like all the way here and then down. At $200 right here, they're going to start making upwards of negative infinity dollars, because as the stock price goes up, you have the ability to exercise at $200 no matter what. So it's always going to be $200 for you. So this is the point at which it is $200 for GME. On the other side, that's their possible amount of money that they can make off of each share of this contract. That's 100 shares, right? You, on the other hand, have the inverse risk. You have the ability to make negative 20 per share at the beginning. But then, as soon as it hits the strike price, you could make infinity monies, positive infinity. So institutions, being the house that they are, if this is a casino analogy, you are then going to make a hedge, right? The institution that sold you this contract is going to make a hedge. Basically, they're going to start hedging the number of shares that they have all the way up to $200 so that it actually looks more like this. So the line that, let me actually go to their hedge looks something like this. They don't want to lose money all the way up to $200. In fact, they actually would like to join you along this rocket all the way up, right? And so they can't do that because you're going to reap all the benefits, the delta from $200. So they would actually just follow along and make a big fat 0 at the end of the day. The reason why is because they need to buy a certain number of the stocks as the price goes up to $200. And at $200, they're likely going to buy all of it.
Did you just say that GameStop pays off all their debts and do not have to wait until
instead of
April
this yellow
30th
line, they want it to
dividends?
be this red line instead. So in that sense, if a $12 strike price is what we're looking at for DFV, Roaring Kitty already has all of his shares covered. So let me repeat. He is someone of these 32,000 calls expiring, right? 32,000 calls times 100 shares is going to be 3 million shares of GME expiring in the money, which means the people that have that share can either exercise it or sell it. They're worth something. All of these shares that are out of the money, though, let's go and down to the options data here. At the expiry date of the 16th, there are 150,000, 5 times as many shares that are out of the money, which means maybe a $200 strike price, right? Maybe at $200, a lot of people have bet that GME would reach it before 4/16, just like the example that we saw. Well, unfortunately, you're not going to be able to exercise those calls, and they're going to expire worthless if you hold them all the way to expiry by the end of the day. So, number one takeaway here is that you do need to worry about when the calls get what the price of the stock is at the end of the day. At the end of the closing day, when after hours start, that is where the cutoff is. Any strike price that is higher than the closing price on Friday is going to be out of the money in just like these 150,000 shares. Every share that is deep in the money, like Mr. Roaring Kitty, has already been bought by the hedge funds. So we're not expecting that to be a major catalyst. So Roaring Kitty getting us hyped up, right? Saying that he's going to get ready to exercise soon, it's not really going to be a major catalyst on his side, but he is going to make himself a lot of money, as we saw from the curves that we saw for the amount of money that the person that makes the call can make and the person that sells the call can make. As a reminder, do not right? Repeat, do not engage in options until you fully understand. That was a baby, smooth brain ape explanation of options. You didn't understand any of the Greek. You didn't understand any of the risk involved besides the infinity, positive infinity. So as a reminder, don't engage in options, especially if you want to help the squeeze, because something called conversions can actually hurt the stock as you buy options that you're trying to help the stock instead. That's why buy and hold is the strategy that we have been touting. But once again, none of that was financial advice. Now that we have gone over this, let us cover, let me get this other one here. Boom. Let us cover calls for 416. A little nudge and hedgies are effed, right? So we gave you a lot of meat in the beginning. Now let's take a look at this DD by user Chief Ooga Booga. Very cool name. Give him an upvote and check out the source in the description down below. So we are 2 minutes away from power hour. Likely gonna have to ring that bell in the middle of this, but let's take a look here. Give a quick rundown on calls for the smooth brain and new apes to make sure that you understand. Call is an option that gives you the right to buy 100 shares of whatever strike price is, right? So this is just a different way to explain what I just explained. If your call finishes in the money, you can either exercise the call, what DFV is about to do, or sell to close at the delta between the strike price and the value of the shares. For example, we're sitting about 160 right now. So a $150 call would be in the money for about $10 per share or $1,000. So this is just a different way to explain what I just drew out visually. The important part to understand with calls is that call sellers hedge these calls, right? What a lot of people don't understand is how that process works. The call seller, well, if you remember a video that explains step by step exactly how gamma squeeze works and how the Greek side of the institutions, that is on the channel. I'm going to try to find it and put it in the description of this video, but if not, watch a playlist until you get to that video, because that was from maybe 2 weeks ago. Delta is expressed in decimal figures, so if the delta is 50 cents, the market maker would hedge with 50 shares out of 100 that are at risk if the call goes in the money. If a call is already deep in the money, the delta would be 1, so they would have a total of 100 shares on hand. So essentially, whenever they have a strike price that meets the price of the stock itself, Greeks aside, right, a little more finagling aside, they're likely going to have to buy all of those shares already. So the hedge funds or the institutions that sold you that call, they have to hedge, because otherwise their risk profile doesn't make sense. So here's a little bit more about exactly a specific example. So all of a sudden, the market makers are scrambling, trying to hedge to where the delta tells them where they should be. All this does is cause the price to rise further. This is the gamma squeeze, if you guys still have not heard a clear explanation of it. So here is the option chain for GME. It doesn't list all of the call strikes because there are a ton, but it does hit the major strikes. It also has a running total at each price and the sum total at $800. That's right, 165,000 calls this week. We saw that in the Stonko tracker here. There are 32,000 calls in the money right now. That represents 3 million shares, where we just did the little mental math we did together. The deep in the money calls should be 100% hedged. Let me ring the bell for power hour. Everything above $140 is about 80% hedged on average. The market makers need to buy some shares, but not a ton. However, what if we crank the price up to 300? Well, at 170, the delta is 37.37, so they have to have 37 shares on hand per call. At $300, the delta is only 0.058, so they need 6 shares per call. They're not doing the math, they just average and say they need to buy between 80 shares per call to average to hedge these if these strikes go in the money. There's about 39,000 calls between $170 and $300. That's just under 3 million shares that would need to buy to hedge between 170 and 300. Plus everything still needs to hedge below that, maybe an extra million. This is where it gets terrifying, and this is where we get rewarded for staying to the part of the video. If having to buy 4 million real shares on top of regular trades combined with FOMO from rapidly rising prices kicks this thing into high gear, there is an additional 87,000 calls between 300 and 800, most of which haven't been hedged at all. They're just too far out of the money. That would add 8 million shares to the 4 they already bought. That's over 12 million shares. That's over 25% of the float, and we already own the float. they're not trying to get everyone too amped up, but there's a lot of stuff happening. It happens that when it happens, so don't be disappointed if it isn't this week. All we're saying is that a few big investors gave this thing a little nudge, and other people caught the FOMO. The next 2 days could be the start of something we've all been waiting for. Too long didn't read. Hedgies could be screwed with a little more pressure. So pressure it is. We've seen the IV decrease, which makes the gamma the gamma squeeze a little bit more probable. Every single week, the IV continues to decrease. I want to thank those of you who asked these questions. And once again, Organic One Co asked about investment books. So go down in the description below and check those books out. They're a little bit further down, but you'll be able to see and support the show using those affiliate links at no extra cost to you. If you did want to help the show at cost, then the way to do that is to press the join button next to the subscribe button and the Patreon link, which is also down below as well. Thanks to those of you who have done exactly that and now get to show up on the end screen, and we'll all see you in the money. Peace. Every time Meatball shows up in frame, I end up getting out of focus. So, because the camera loves him.